Hey there, I'm Gemini. That battery can last up to 24 hours even with the always-on display turned on. It's pretty cool.
So, your company operates across borders and has a footprint in Canada. Well, there's one question you just can't ignore. Are you on the hook for Canadian taxes? It's a really critical question, and believe me, the answer isn't always simple. In this explainer, we're going to break down Canada's rules for taxing foreign corporations. We're going to give you a clear step-by-step framework to navigate what can definitely feel like a complex maze.
So here's how we're going to tackle this. Think of it like a decision tree. First, we'll look at what it even means to be in business in Canada, and you might be surprised at how low that bar is. Then we'll explore this crucial safety net provided by tax treaties. After that, we dive into the single most important factor, the permanent establishment test. And to wrap it all up, we'll cover your exact filing duties and, maybe most importantly, the pretty significant costs of getting this wrong. Okay, let's set the stage. First up, we need to get a handle on the basic landscape of doing business in Canada, at least from a tax point of view.
This is it, right? The core question. This is the one that probably keeps some CFOs up at night. Does your activity in Canada actually trigger a tax obligation? Well, by the end of this, you are going to have the exact step-by-step process to find that answer for your company.
All right, step one. This is the absolute starting point. Before we even start talking about things like tax treaties, we have to answer a really fundamental question. From a legal standpoint, does Canada even consider your company to be carrying on a business here?
And this is super important to understand. The threshold for carrying on a business in Canada is, quite frankly, set really low, and that's on purpose. You don't need some huge office building or a big team on the ground. Things as simple as having an agent who's soliciting sales for you or even just providing certain services in the country. That can be enough to clear this first hurdle and pull you right into the Canadian tax system.
So, this brings us to a fork in the road. If your activities somehow fall below that very low threshold, great, you're in the clear. No tax, no filing, you're good to go. But for most companies that have any kind of real presence, the answer here is going to be yes, and that means we're not done yet. We've got to move on to the next step in our process.
Okay, so you've figured out that yes, you are carrying on business in Canada. So does that automatically mean you owe tax? Well, not necessarily. This is where a really critical protection can come into play, what we call the treaty safety net. You see, Canada has tax treaties with dozens and dozens of countries all over the world. Their main job is to prevent what's called double taxation, basically making sure your profits aren't taxed once in your home country and then taxed all over again in Canada. Now, these treaties offer huge relief, but here's the catch. You have to meet very specific conditions to actually get that protection.
So, if your company is based in a country that has one of these treaties, the whole thing really hinges on one pivotal concept, the permanent establishment test. Honestly, this is the single most critical factor, and it's where the details really matter.
This quote from our source material just nails it. While the process might seem pretty straightforward so far, this is where things can get really complex. Figuring out whether or not you have a permanent establishment, or a PE, is probably the most challenging and most important part of this entire puzzle.
So what in the world is a permanent establishment? Well, the most obvious example is just a fixed place of business. An office, a factory, a workshop. But it's actually much broader than that. A PE can also be created just by the activities of your people on the ground. For instance, if you have an employee in Canada who actually has the authority to sign and conclude contracts on your company's behalf, bam, that can create a PE. The bottom line is this: if you have a PE, Canada gets to tax your profits. If you don't, the treaty acts like a shield.
So really, this entire analysis just boils down to 3 possible scenarios. Scenario 1, you're in a treaty country and you have no PE. That's the best case outcome for sure. Scenario 2, you're in a treaty country, but you do have a PE. And Scenario 3 is the simplest of all. Your country has no tax treaty with Canada. In that case, the whole PE test is irrelevant. So now let's see how each of these directly impacts what you have to do.
Okay, so we've walked through the whole decision tree. Now let's get practical. What are your specific tax and filing obligations depending on which one of those 3 scenarios you fall into?
Think of this table as your cheat sheet. Now, look at that first row. This is so important. Even if the treaty protects you from paying any tax because you don't have a PE, you are still required to file a special return. It's called a treaty-based return. This is a compliance step that a lot of companies miss. For the other 2 scenarios, if you have a PE or if your country has no treaty at all, the outcome's the same. You are liable for Canadian income tax, and you have to file what's called a Canadian branch tax return.
And let me tell you, deadlines are everything. If you owe tax, that payment is due just 2 months after your company's fiscal year end. That's a really tight turnaround. You get a little more breathing room for the actual paperwork. You have 6 months after your year end to file the tax return, whether it's the full branch return or that simpler treaty-based one.
Now, there is some good news here when it comes to double taxation. The whole system is designed so you're not penalized for operating internationally. Basically, any income tax you end up paying to Canada can generally be claimed as a foreign tax credit back in your home country. This directly reduces your tax bill at home. It's a mechanism that ensures the same dollar of profit doesn't get hit with tax twice.
We've covered what you're supposed to do, but what happens if you just don't? It is so crucial to understand that failing to comply carries some significant and really long-lasting risks. This is not something you want to take lightly.
Let's start with the immediate hit to your wallet for simply failing to file a required return. And this is critical, even that treaty-based return that shows you owe zero tax. The minimum penalty is $2,500, plus interest. That is a very expensive price to pay for what might seem like a simple paperwork oversight.
But that financial penalty? It's not even the biggest risk. This is. See, normally there's a time limit on how far back Canada's tax authority, the CRA, can go to audit you. But if you never file a tax return for a given year, that audit clock never starts ticking. It means the CRA can come back and assess taxes, penalties, and interest for that year, 5, 10, even 20 years in the future. It creates this open-ended liability just hanging over your business.
And remember, our focus today has been squarely on corporate income tax, but that's just one piece of the Canadian tax puzzle. Depending on your operations, you might also have obligations for things like withholding taxes on payments, payroll taxes for any Canadian employees, and of course sales taxes like GST or HST. It's really a whole ecosystem of compliance you have to be aware of.
So, to wrap up our entire journey, here is the decision-making path. It's a 5-step process. It takes you from that initial broad question of carrying on business all the way down to the nitty-gritty of what to file and when to file it. Following these steps methodically, that is the absolute key to managing your Canadian tax risk. And that brings us to our final thought. Look, getting compliance right, that's step 1. That's the foundation. But the ultimate goal is strategy. It's not just about paying what you owe, it's about structuring your Canadian operations intelligently. So the real question you should be asking yourself is this: is our current setup actually designed to achieve the lowest possible effective tax rate for our company on a global scale? Now that's the next level of planning.